Okay, folks, quick reminder, your third quiz is a week from today. And it feels like just last week, like you took your last quiz. But because the break was so late this year, there was almost nothing I could do because by the time I didn't want to give it the week you came back from break, obviously. So the third quiz will cover capital structure, which is pretty much what we will do through much of it we've already done, but we'll finish off this week. And then, of course, 2 weeks after that is the last day of class and then finals. So, lots coming up, and I'll keep reminding you, don't worry, lots of nagging coming up. Um, so today we're going to continue our discussion and finish up this financing mix question. If you remember, we were talking about finding the right mix of debt and equity for your company. Okay? You can use the cost of capital approach, you can use the APV approach, you can look at your peer group, but we started with this presumption of what if your company's debt ratio is different from the optimal? And we looked at the easier half, right? When you're under-levered, what can you do? And the key question there was, do we need to do something quickly? Okay? If you're under threat of takeover, you don't have the luxury of time, you got to go out and increase leverage quickly. Do a debt for equity swap, buy back stock with borrowed money, but increasing your debt ratio quickly. But if you can, it's probably better to spread this out. Take your time doing it because that way, if you misestimated your optimal, you can fix it as you go along. Okay? And there, the follow-up question I asked was, do you have good projects? The reason that matters, if you have good projects and you have debt capacity, you have a marriage made in heaven. You can use the debt capacity to get to your optimal and then get the net present values of the good projects to add on top of that. It's always better to borrow money and take great projects than it is to borrow money and buy back stock. And if you do borrow money, if you don't have good projects, then of course you have to decide what to do over time. And there's one final question. There are two ways in which you can return cash to your shareholders. One is to pay dividends, and the other is to buy back stock. Which one's better? Depends on your shareholders. I mean, think like a shareholder. Now, dividends versus buybacks, and this is something we'll come back to. The key question is, do I want the cash now and have to pay taxes right now? In which case, you're saying, I'll get the dividends. Older investors, poorer investors tend to prefer dividends. But there's a whole set of investors who said, don't pay me dividends. I don't want to pay tax. I'd prefer to get the price appreciation. Whichever group of shareholders are the shareholders in your company, we'll talk about this, called a dividend clientele, is going to drive what you pay. So that's if you're under leveraged. And if you're going to have a problem, as I said, hope and pray that you have too little debt. Because here's the other side of the equation, and here things get unpleasant. What if you have too much debt? Your actual debt ratio is 60%, you need to be at 30%. You're saying, just reverse everything, right? You just need to bring your debt ratio. Let's go through each of the things you're going to try to do and why it's going to be difficult for you to do it. You're the CEO of a company. Weight Watchers. Significant trouble now. Why? Couple of reasons. The name itself is a problem now, right? It's Weight Watchers at one point in time was, now people, when you put in that as the name of the company, you already are going to have issues with you picking on people who are overweight. So, but that was from a different. But Ozempic and Wegovy had basically killed their business model. The company's in trouble. So as I go through the choices, think about whether any of these is going to work for Weight Watchers. The first question I'm going to ask is the company under threat of bankruptcy? What do you look at to make that judgment? The case of Weight Watchers, what are the things that give away the fact they're in trouble? One is the rating, right? If you look at the ratings, they're now down to, I think, C double. I mean, they're well below investment grade. They've dropped to a point where the ratings agencies have put them in what? Saying any day now. This morning, I was looking at news story. Every single news story I read in the last 6 months about Weight Watchers is about how death is imminent. When you're under bankruptcy threat, there's no need for serious research. You will know. If you work at that company, you will know. Your paychecks might bounce. And every aspect of the company is going to be depressing because you're in a pathway to doom. So let's look at some of the things you could try to do, and let's see if these will work for Weight Watchers. One is you can go to your lenders and offer them equity in your company to replace the debt. Think like a lender. I come to you and say, look, would you like equity in my company? What's your first reaction? No, thank you. You can ask your lenders, you can try to sell assets. The case of Weight Watchers, what assets do they have? Maybe the lists of, because they do have a list of people who are loyal to the Weight Watchers. Maybe they can sell that list. But if everybody knows you need the cash right away, your bargaining power is shot to hell. So when you try to sell things, you're not going to get full value. You might get half of value, a quarter of value. So you can try, but it's going to be difficult. What if you try to renegotiate with their lenders? Make the 3-year loan into a 30-year loan. Make a 12% interest rate into 1.2% interest rate. What's your reaction as a lender? I'm not doing it. But you know what I threaten you with? What happens if I decide to actually declare bankruptcy? I end up in the courts and the lawyers are going to take it anyway. So would you take these terms or wait 30 years to get your money after all this process works through? It's ironic, but your bargaining power as a borrower is greatest before you actually declare bankruptcy. So you go to the lenders and say, hey, do you want me to declare? It's like negotiating with somebody who owes money to you and has a gun to his or her head saying, you either agree to my terms or I'll blow my brains out. Right? You're not going to get any of your money. Essentially, you're negotiating, saying, look, if you don't agree to my terms, effectively, I'm going to go end up in the court system. You're not going to see your money. To give you an example of how effective this strategy is, in the 1800s, Peru had a debt problem, which is not new. It's Latin America. Every country goes through a debt problem. Peru had a debt problem. So it was the French bank that had lent the money. So the time for the debt payment came due, and Peru didn't have the money. So they send out, I don't know how you sent out messages then. So by carrier pigeon, I guess, or by ship, saying, we don't have the money, but we can pay with guano. You know what guano is? It's bird droppings, right? Bird droppings actually what fertilizer, they're supposed to be really good. So we don't, the French bank initially said, no, no, we don't take guano, we need cash. And Peru said it's guano or nothing. And the French bank said, we'll take the guano, right? Basically, you know that if you tip this company over the edge and you end up in bankruptcy court, you might see less than you get in these, and that's why these renegotiations with companies that are on the verge of bankruptcy or even in bankruptcy become so intense because the lenders try to get something to keep the company going. But it's not a good place to be. But could you be over-levered and not under bankruptcy threat? Absolutely. You can still be a healthy company, but know that you have more debt than you should, in which case you have the luxury of time. And here again, I'm going to ask you the same question I asked you when you had excess debt capacity. Do you have good projects? Because if you do, here's what I think you should do. You should take all of your earnings every year. Stop paying dividends, right? If you're over levered, the last thing you want to do is make your equity lower. So stop paying dividends, stop buying back stock, take every dollar of earnings and pump it back into those good projects. And over time, here's what will happen. Your equity will rise in value. It's not even that your debt goes down. You essentially grow out of the problem. It's the nicest way to get rid of a debt problem is essentially increase the value of your firm to the point where your debt problem goes away. So if you have the luxury of time and you have good projects, go take the good projects with equity. In this case, retained earnings. And over time, your debt ratio will decrease, your debt problem will go away. But if you don't have good projects, again, you're back on this treadmill of having to pay down debt over time. And you try your best. You take your retained earnings, you pay down your debt, and over time, you hope to get back to health. And you hope there's no macro crisis that happens. A tariff war will essentially tip you over, something you did not anticipate. But there are a lot of companies right now that are waiting to see. They thought they were on the pathway to bring their debt down. They're looking now to see maybe we won't be able to make it. That's a framework. I'm going to try to apply it for Disney, but I'd like you to think about applying this for your companies when you get to the point of having an optimal debt ratio. So Disney in November of 2013, their actual debt ratio was 12%. The optimal was 40%. They were under levered. Are they under takeover threat? At least in 2013, I thought not. And I'll give you my reasons why. One, it's a pretty large company, 130 billion. Right? Second, there's no insider holding, so that works against it. But there's a third factor, which if you remember the Jensen's alpha that I computed for Disney. Does anybody remember? It was 9.02% a year for the 5 years leading to 2013. You're negotiating from a position of strength if you're Disney. So essentially, I assume that they would not be targeted because of those factors. It's a subjective judgment, and each of you will have to do this with your company, right? Do they have good projects? Again, if you remember, when we looked at the return on capital Disney, it was 12.61% above their cost of capital. They were earning excess returns. Will they continue to? I'm assuming they can. So in the case of Disney, given that they have plans to expand their theme parks, build new ones, build up their movie businesses, at that point in time, streaming was not an issue. I said, take projects with that, but I'm going to keep an eye on those projects. If those projects start tipping over and become negative net present value, I want my cash back. This was at the heart of the activist targeting of Disney last year. Disney was borrowing money, but what was it investing the money in? What was the business that all the money went into? Disney Plus. And what was Disney Plus doing? It was draining cash like crazy. So before Iger came back, when Bob Chapek was doing it, activists said, hey, this can't go on. You're going to suck the company dry. And essentially, you saw the fight over that. And Disney conceded. In a sense, they become a little more restrained in how much money they spend on Disney streaming. So that was my Disney framework. And you, as you work through your company, make the best judgments you can. There's no checkbox. You can say, hey, no, I know for sure. But make your judgments to decide. And some of your companies will be over-levered. You have to figure out, are they under bankruptcy threat? If they have a rating, you can look at the rating. But more simply, look at their interest expenses, look at their earnings, say, will they get into trouble if they get a shock? And if they do, if they are on the verge of trouble, you have to do something quickly. So when you look at your firm, here are the choices you'll face. Maybe there's no change in leverage needed. That could happen for some of your firms. In some, you might need an immediate change, either because they're under bankruptcy threat when they're over levered, or because they could be taken over, or they could have a gradual change. And if they decide to change their debt, there are two pathways they can go. One is stay entirely on the liability side of the balance sheet, where you either increase debt or increase equity. The other is to try to take projects with that additional debt or additional equity. So those are the two choices you'll face. So to complete this process, I'm going to list out some of the ways in which a company can increase its debt ratio or decrease its debt ratio quickly, and some of the ways it can increase or decrease its debt ratio gradually. I've kind of listed them already, but might as well pull them all together. So if you want to increase your debt ratio, if you want to stay entirely on the liability side, you can borrow money and either buy back stock or pay a special dividend. Why does it help? Borrowing money increases your debt right away. Buying back stock or paying a dividend reduces equity. You can make your debt ratio go from 0 to 40% in no time at all. Okay? If you want to decrease your debt rate, or if you want to, let's stay with increase the debt ratio. You can also take your assets, sell them off, use the cash to buy back stock. What does that do? It reduces equity. If you already have debt, your debt ratio will increase. So if you're a company with debt already existing, you can sell off assets, buy back stock, divest a division, do a buyback, and that'll increase your debt ratio. If you want to decrease your debt ratio quickly, again, you can stay on the liability side, try to issue new equity and use it to retire debt. That'll increase your equity, reduce your debt, increase your equity, the proportion of your capital that comes from equity essentially overnight. Or if you want to do it by selling assets, you can sell the assets, use them to pay down debt. So depending on which problem you have, under levered or over levered, you have levers under your control. Now, if you want to increase your debt ratio, decrease it gradually. If you look over time, if you want to increase your debt ratio, you'd either have to use dividends or buybacks. Either reduces equity. So whatever you're doing, you're essentially looking at that balance between debt and equity. The one thing about changing debt ratios gradually over time is you're targeting a firm value that will actually shift over time. And here's the reason. Let's say a company's worth $1 billion today in market cap terms. If it's fairly valued, it should be worth 1.8 billion next year, 1.15 billion the year after. Looks like I'm making up stuff, right? No. So, but why would the value of your firm change over time? And what will it change by if it's fairly valued? What's the cost of equity? It's what the equity should earn for you as an investor. If a stock is fairly valued, its equity should increase by the cost of equity year after year. So what that means, a 40% debt ratio in 5 years will be a much, much higher amount of debt than a 40% debt ratio today, right? Because you're targeting a bigger firm. So tougher to do, but again, it's just details. The mechanics of doing it are pretty straightforward. So that's the financing mix part. Any questions at all about the financing mix? So be open to the possibility that your company's optimal debt ratio can be 0%. It might not be because you've done something wrong. It just might be that your company really can't afford to get even to a 10% debt ratio. It doesn't have the earnings. And leave open the possibility that at least for some companies, your optimal debt ratio can be 70, 80, or once in a while you might get a 90% debt ratio for a company. And those are the kinds of companies you targeted if you're a leverage buyout, practitioner. Those are the kinds of companies that can carry immense amounts of debt. So now let's look at the second half of the financing principle. If you remember, I said the objective when you go out and borrow money is to match your debt up to your assets. So I want to start by explaining why that helps you as a company. Where does it show up? And then talk about the mechanics of designing debt from scratch. So let's start by looking at a company where the firm value goes up and down for lots of different reasons. A cyclical company, the value goes up some years, goes down. If this company goes out and borrows debt that remains constant in value over time, it's going to be in trouble. Every time the firm value drops below the value of the debt, technically this company is bankrupt. It might not be forced into bankruptcy, but its equity is worth nothing. Let's say I take the same company and I redesign the debt so that it increases and decreases with the value of the firm. In other words, when the value of the firm goes up, the value of the debt goes up, the value of the firm goes down, the value of the debt goes down. It's a very strange kind of debt. We'll talk about how we can try to do it. This company never goes bankrupt, even though it has 30% more debt than the previous company. The reason we want to match debt up to the assets reduces default risk. And by reducing default risk, it reduces your cost of debt and your cost of capital. It allows you to borrow more money. So what we're going to try to do is take a company, and as I go through this process, I want you to start thinking about your company and think about how you'd go through this process of designing debt. So first step in the process. So let's suppose you're the company and I am the person trying to design debt for you. I'm going to have a series of questions, and as I list the questions, let's think about why they matter. First question I'm going to ask you is, typically, how long-term are your projects? So let's take a few examples. Take Boeing. What does a typical project's duration look like? Probably takes 10, 15, 20 years of R&D, and then if the R&D looks like it's going to work, you build an assembly plant that might take another 5 years. And then you use that assembly plant to make aircraft for the next 30 years. The last Boeing 747 rolled off the assembly lines 40 years after the first one. From start to finish, that was a 50 to 60-year project. So what kind of debt should Boeing take? Really long-term debt. Boeing was one or two companies that issued 100-year bonds. This is a long time ago, 15 years ago, 100-year bonds, 100-year corporate bonds. The other company was Disney. We'll talk about why Disney might issue 100-year bonds, but you can see what. In contrast, let's take Oracle. What's a typical project look like for Oracle? Definitely not 60 years, probably 8, 10 years, maybe even 6 or 7 years. Technology companies, because the technology shifts. So if you're looking at a technology company, I would expect to see a 100-year debt on your balance sheet because your typical assets are much more short-term. Let's take a third example. Let's take Coca-Cola. What's its biggest asset? I'm sorry, what? Do you think the taste actually matters? Coca-Cola thought it did, right? Remember in 1986, they tried to fix the taste with new Coke, old Coke, and they realized nobody cared. And in fact, the taste was not the issue. That if you put crap in a red can and put Coca-Cola on it, the, the mind would take over and you drink it. It tastes incredibly good. It's a Coca-Cola. It's brand name, right? I mean, let's face it. Every soda, if you really did a blindfold test, even say I know Coca-Cola when I drink it, I could give you three different Coca-Colas from three different parts of the world. Now, I'd always drink the Mexican Coca-Cola when I'm in San Diego because I like the sugar in my Coca-Cola. Tastes very different from traditional Coca-Cola. It's brand name. Is brand name a really long-term asset or a short-term asset? It's perhaps the longest-term asset known in business, right? Look at how long Coca-Cola's brand name has lasted. Because it's mysterious. Nobody knows where it comes from. Nobody knows sometimes why it goes away. If your biggest asset brand name and you think about borrowing money to build up that brand name, you should probably take long-term debt. So I want you to think out of the box when you think about what does a typical project look like. You're saying, what about a bottling plant? Why doesn't that work for Coca-Cola to use the bottling plants? Because they don't actually own the bottling plants anymore. They've spun off the bottlers. They're purely the syrup and the brand name. That's all the company is. So the first question I'm going to ask you is about the duration of your projects. Second stop, I'm going to ask you what currency are your cash flows in? So let's stay with Coca-Cola. What currency the cash flow is going to be in? 70 different currencies. As best as I can, I want to design debt that reflects your currency mix. Again, because I want to match debt up to your assets. It's easier to do with Coca-Cola than with Boeing because with Boeing, the currency mix keeps shifting because every time they sign a new aircraft contract, it depends on which airline they sell it to. You know? So if it's to Qatar Air, you're going to get it in a very different currency than if you sell to Singapore Air. So much more difficult to do because the currency mix gets staggered, but best as you can, you want to try to match your debt up in terms of currencies. The third question I'm going to ask you is going to sound strange, but we'll see why it matters. I'm going to ask you how your cash flows respond to inflation or how you as a business respond to inflation. So let's say as a business, when you have inflation, what's the first effect you have? Your costs all start to go up, right? And as a company, what would you like to do? You'd like to pass those costs on to your customers to survive. The question I'm asking is how much pricing power do you have? If you have lots of pricing power, you're going to be able to pass inflation through to your customers. You think, why do I care? Remember the choice between fixed rate and floating rate debt? Derek explained to me how floating rate debt works. And the driver for interest rates is inflation, right? So if inflation in 2 years is going to be 8%, the interest rates are going to go up. And if you have floating rate debt, your expenses are going to go up. You're saying, oh my God, what am I going to do? If you have pricing power, you just pass it through. You see where this is going to lead me, right? If I have pricing power, I'm a much better candidate for floating rate debt than if I don't have pricing power. If you're an airline, for God's sakes, don't issue floating rate debt. You don't have pricing power. And if you don't have pricing power, when interest rates go up, you're going to get squeezed and perhaps go bankrupt. The fourth question I'm going to ask you, are you a growth company? Are you a mature company? I'm asking about, are you Walmart or Costco, in which case much of your high growth is behind you, or you Celsius, where a lot of high growth is ahead of you? Why does that matter? That's going to drive the choice between straight debt and convertible debt. Convertible debt is debt with an equity option added on. By itself, it's neither better nor worse, but one of the advantages of issuing convertible debt is your coupon rate will be low because it's because you gave away that equity option. And if you're a growth company, that's exactly what you want. You want the coupon expenses to be low now because you can't afford to make big interest payments. And over time, they might get converted to straight debt. But if things go well, you should be able to make those debt payments later. So if you're a high growth company, much better candidate for convertible debt. If you're a low growth company, go with straight debt. Why give away options? And there's a final question I'm going to ask you, which is completely company specific. Tell me what else affects your cash flows, and I'm going to try to bring it into the debt. Let's not be mysterious. Let me give you an example. Let's suppose you're Barrick Gold mining company. What's the biggest single factor driving your earnings? It's gold prices, right? Gold prices go up, your earnings go up. Gold prices go down, your earnings go down. Is there a way I could design debt that lets a gold mining company borrow money and not have to go bankrupt if all gold prices collapse? What would I have to do? Wait, tie the coupon rate to the price of gold, right? The very first, this is a group of bonds called commodity linked bonds, and the very first commodity linked bonds were gold linked bonds in the early 1980s. Gold prices go up, your coupon rate can be 12%. Gold prices collapse, the coupon rate can go to 2%. Now, of course, that's expanded out. In fact, one of the things that's always puzzled me is why smaller oil companies don't all issue oil-linked bonds. Because every one of them, when oil prices drop, I mean, last week there was talk about shale oil companies going bankrupt because the oil price had gone to $57 a barrel. If you tied the coupon rate, you're not giving away anything, right? It's built into the price. So essentially, you're doing it to match up your debt to your assets. It is true that you can issue regular bonds and then use derivatives to try to manage that risk, right? But that's asking for trouble. Why not build it into the bond in the first place so you don't have to go out and use options and futures to manage that divergence? So the first stop is to make sure you're designing debt that matches the business. In the real world, how do businesses pick what debt to issue? They call in an investment banker and they say, tell me what debt's right for me. This is like going into an electronics store and asking the guy, say, can you tell me what the right TV for me is? I'll predict what you're going to come back with. That OLED Samsung $3,000 80-inch TV that won't even fit in your apartment. But it's, he's doing what's right for him. If you ask bankers what the right debt for you is, they don't know your business like you do. The people who are best positioned to determine what the right debt for them are the people running the business. And this isn't rocket science. You're saying, what are the things I worry about, and can I bring them into the debt? So that's the first stop, is to make sure your debt and your assets are matched up. Any questions? Yes.
Boeing.
Yep.
It's like a predictable, like R&D phase. I don't think of it as like a construction loan when they do like the
Right. If this is your first aircraft and you have only one aircraft working through, it's going to be messy, right? Because in that initial period, when you have all negative cash flows, the lender is lending based on expectations of future cash flows, and that's project financing. So you have to line up things in there to protect you. The advantage when you have a company like Boeing is you have a portfolio of projects at different stages. So as the 747 rolled in, the 707 was still throwing off lots of cash flows. So what the lender is lending against is the portfolio of infrastructure projects, and that way the cash flows. So that's why it's so much more difficult designing debt for a company starting off with a single project. It gets easier. Biotech companies can't borrow money. Why? It's a single project working its way through the pipeline. All negative cash flows, but nobody's going to lend you money in those early phases because they have no idea what's going to show up. But as you get a portfolio of projects, you borrow against a portfolio. Okay. So second stop, make sure you haven't been too clever for your own good. Let me explain. What we were doing with the debt on the previous page, we were trying to make debt look like equity, right? That's basically what we're trying. In fact, you might have been so good at designing debt that looks like equity that the IRS looks at it and say, you know what? That's equity. In which case, the entire point of issuing debt goes away. So make sure that whatever you've designed to look like equity actually passes the debt test. Who are you going to visit? The tax lawyers, right? They've got to read through the tax law and make sure this passes it. And in that process, you might massage the debt to maximize your tax benefits. I'll give you an example. When you issue zero coupon debt, if you look at the interest, it's zero every year, right? But the way the IRS actually allows you to claim tax benefits is on an imputed interest expense. That's something you need to know when you go out and decide what kind of debt to issue. So make sure the debt is deductible. And if you're a multinational, this is the point at which you decide that your debt is going to be in Germany rather than Ireland, because you get a 29% tax benefit. So design the perfect debt, make sure you get the tax advantages. Third stop, it's a trick you got to pull off that I don't even know how companies manage to, but they try all the time. There are three very different groups of interests in here, and you got to try to keep them all happy. So let's play this out. You're a Midwestern company, you're the CFO, you want to issue a security next week, and you're going to visit New York to make sure the security is well received. So your first stop is at Moody's, the ratings agency. So let me ask you a question. What do ratings agencies care about? What's the one thing they're focused on? Default risk, default risk, default risk, right? So what do they want you to issue next week to reduce default risk? Debt or equity? They want you to issue equity. So you tell them in the morning, oh, hey, I'm issuing equity. You're saying, what's the big deal? In the afternoon, you visit the equity research analysts who track your company. Do they like it when you issue equity? In fact, when you issue equity, what happens to your share count? It goes up, and then the dilution bogeyman comes out of the closet. So you got to convince these equity research analysts that the same security that you convinced the ratings agency was equity this morning has now magically become debt. But we're not done. If you're a regulated company, there's a third stop to make. Insurance company, bank. What do they need? All their regulatory capital ratios are built around equity. So they want you to, so this security goes back to being, so it starts the morning as equity, in the middle of the day it becomes debt, and by the end of the day it's back to being equity again. Think who can pull that off? You know how much money banks make threading the needle trying to, because each of these groups has different definitions of debt. And what banks do often is thread the needle and convince each group that they're getting exactly what they want. So I'll give you an example. It's called trust preferred stock. And I'm going to first describe what it looks like. And then I want you to remember the distinction we drew between debt and equity and tell me which bucket you would put it into. And then I'll talk through what exactly happened when it was created. First, its birthplace is kind of unclear. It's either born at Goldman Sachs or one of the other investment banks. The banker who created it is kind of passed on into posterity. But here's what trust preferred stock looked like. It came with a fixed dividend payment that was set contractually upfront. That fixed dividend payment was tax deductible. This banker managed to convince the IRS that it was more like interest than dividends, it was tax deductible. And if you failed to make the fixed dividend payment, you didn't default, but the holders of the trust preferred got voting rights and essentially became common stock. Fixed dividend, tax deductible, loss of control. That looks an awful lot like debt or equity. That looks like debt to me. And here was the final coup that the banker pulled off. He got the ratings agencies to classify it as equity. I ran into one of the people who sat on that committee that classified as equity, and I said, what were you guys even thinking? Why would you treat this as equity? And he gave me two reasons, one stupid and one incredibly stupid. I'll give you the stupid reason first. He said, it didn't come with a maturity date. Debt usually comes with a finite maturity, equity doesn't. And that kind of makes sense, right? Until you remember that Boeing issued how many, what was the maturity of those bonds? 100-year bond, right? Do any of you buy a 100-year bond expecting to collect the face value? I hope not, because you're being incredibly optimistic, right? And once you've gone 100 years, why not go 1,000 years or make those console bonds? The Canadian and the British governments used to issue bonds which did not come with a maturity date. If I were advising Boeing, I'd say issue console bonds. You might have to pay a slightly higher interest rate, but the ratings agencies are going to treat it as equity and keep increasing your rating as you issue debt. That was the stupid reason. You know, the incredibly stupid reason was? He said it was called preferred stock. Come on, guys. You've opened a door for me where I'm going to go on a renaming convention where I'm going to take everything on my balance sheet. It's a long-term debt. We don't call that a debt anymore. We call that long-term preferred stock. You can't classify something as debt or equity based on what it's called. But they classify it as equity. And now you can see why. I mean, this was an incredibly profitable security for banks to get companies to issue. Why? Because banks, companies that couldn't afford to borrow money could now issue preferred stock to raise money and actually have their rating go up while they were actually borrowing money. So if you went to work for an investment bank in the early 90s, incredible pressure on you to convince every person who walked in through the door that the right security for them was trust preferred because you got such a high fee on it. So let's say you can't beat that pressure. You got to do what you are hired to do, but you want to do the least damage you can while you're making your living. So you got to sell trust preferred. And remember all the characters of trust preferred. I want you to tell me which groups of firms will be less damaged by issuing trust preferred or might not be damaged at all. The right group to target trust preferred. So the first group of firms that are underlevered and choose not to borrow money because they have a rating constraint. Remember we talked about, companies have a single A plus. So they're underlevered. They can afford to borrow more, but they're choosing not to because they worry about the rating. The second group of firms are over-levered, but they could slip through this loophole and issue more debt by issuing trust preferred. Which of these two groups is the preferred group if your objective is to not do any damage? The under-levered group with a rating constraint or the over-levered group that can slip through the loophole and issue the trust preferred? Wade, what do you think? And the underlevered group, they have excess debt capacity, which means they have the cash flows, they can issue the trust preferred, they can live, they get their cake and eat it too, right? The rating stays okay, maybe even goes up. The second group, what's the problem with using a loophole and issuing the trust preferred? You fooled the ratings agency, right? But who have you not fooled? I don't think there's something called mother distress. But there is a real distress factor you're going to run into, right? Which is you're over levered, which means you don't have the cash flows to service the debt. And what have I done with your trust preferred? I've added dividend payments on top. You're going to go bankrupt. The only consolation price is you're going to go bankrupt with a really good rating. I don't know what that does for you. But it's amazing how companies and banks thought this was a game. That this was a game, your objective was to fool the ratings agency by slipping through the cracks. Banks play this game with regulatory capital all the time. I mean, if I had my druthers and I were writing the banking laws, I'd write regulatory capital in terms of common equity. If bank is short of regulatory capital, it has to issue shares because they allow you to go with what they call quasi-equity, and that's an opening that banks exploit to create all kinds of strange instruments that look like equity, are called equity, but are really nothing to do with equity. This is not a game. Distress can destroy a company. Your objective is not to fool the rate. I mean, you got to factor in ratings agencies, but you can't make this all about can we fool the ratings agencies. Yes.
Public debt, not debt.
You'd be surprised at how stupid banks can get in this process as well, how lazy they often can be. Because when everybody was lending to telecom, it's true, a big chunk of the debt came from corporate bonds, but it's almost like the banks didn't want to be left out of the game. Because remember, banks have their own incentives to push up their loan portfolios because they look good in the good times, right? You get much more income. So banks are not immune from falling into that spell of everybody else is lending to them. Why shouldn't I do it as well? Yeah. So let's see where we are. You've designed the perfect debt. You got the tax guys okay. You've tried to keep these three groups as happy as you can keep them. You can't make they obviously they won't all be delirious about what you're doing, but at least they're not so deeply disappointed that they take it out on you. The fourth step is you want to check to see if bondholders, if you're issuing public bonds, whether bondholders will buy your bonds. You're saying, why wouldn't they? For two reasons. One is perhaps you've never issued bonds before, right? You're a newbie. And they said, so you have no history. The second is you have a history, but it's a bad history. Remember we talked about the Nabisco, not being Nabisco, RJ Nabisco in 1987, doing a leverage buyout and essentially ripping off their bondholders? 5 years later, Nabisco went back public again and decided to issue bonds again. And nobody would buy their bonds. And who could blame them, right? They remembered 87. So why would we buy your bonds? So if you have no history or a bad history, even if this is the right kind of debt for you, bondholders might not be willing, in which case you got to pay a really high interest rate to get them to buy. So you might have to sugarcoat the bonds, make it acceptable. In the late 80s, the way this, one of the ways companies tried to sugarcoat the bonds is they tried to make the bonds rating sensitive. Merrill Lynch invented these bonds where the coupon rate on the bond would actually change as the rating changed. It was almost a direct consequence of the Nabisco effect, right? Because in Nabisco, what happened was you bought these bonds, which are single A or double A rated bonds, and the company did a leverage buyout and made them double B rated bonds, and your coupon rate stayed fixed. That's what damaged you so much. If your coupon rate adjusts with the rating, obviously, as a bond buyer, you're much more willing to buy bonds saying, hey, even if that happens, I'm okay. Bonds are, especially the post Nabisco, started at an equity component to them, a conversion option. Why? Because if the equity investors are ripping you off, you know what you can do? Become one of them. In which case, who do they have to rip off? Conversion options allowed you to do it. You're sugarcoating the bond to make it acceptable to bondholders. You don't do it because you want to. You don't do it to be nice. You do it because if you didn't do it, you wouldn't be able to issue the bonds at a reasonable interest rate. So when you see a bond issue with all kinds of special features added on, that's actually a signal that the company is not in the best of shape with the bond market and it's trying to make its bonds acceptable. So let's say you manage to do that as well. You got the perfect bond, you got the tax okay, you made these three different groups reasonably happy, you've sugarcoated the bond. You get ready to issue the bond, one final stop you got to make. You don't want to lock in market mistakes that work against you. Let me back up, right? You have a rating as a company. Is that rating the right rating? For some companies, it might be, but let's say you as a company believe you're being underrated. You know what I mean by underrated, right? You should really be single A, but the ratings agency is giving you a triple B rating. And let's say the right kind of debt for you is a long-term fixed rate bond. You don't want to issue that long-term fixed rate bond today because that bond will be priced as if you're a triple B rated company and you believe you deserve an A plus rating. So what should you do? You might use bridge financing. Bridge financing is short-term financing, and then during that period, you're going to go to the ratings agency and try to convince them that they've under. It might not work, but the, if you're underrated, you don't want to lock in that mistake by going out and issuing long-term bonds today. What if you're overrated as a, Caleb, you talked about an overrated company. What are you going to be tempted to do? Mm-hmm. Issue as much as you can, right? In fact, this is part of a more general question. If you're overpriced as a company, Nvidia, when it's 3.3 trillion, or your company, and should you take advantage of what you feel is a market mistake? And your first reaction is, why shouldn't I? It's not I who created the mistakes. So my advice to companies, if you need the money, of course you got to go out and borrow the money. But if you don't need the money, my advice is don't try to take advantage of market mistakes because you have a long-term objective of staying in the market. You don't want to be taking advantage of a mistake for a couple of $100 million and then having to pay for it in a future bond issue. So you're underrated. You want to be careful about kind of issuing long-term debt and locking. You might have to wait. If you're overrated, I will leave it to your conscience and your whatever your sense of business ethics might be in what you need to do. But you're going to see the temptation to go out and raise as much capital as you can from equity if you're overpriced or from debt if you're overrated. And that capital is then going to sit on your balance sheet and you'll be tempted to do stupid things with it. So there are all kinds of things that emerge from that. So that's the entire process. Don't get this is just the previous 5 pages pulled together in one. It essentially goes through the process. I don't see why you need a banker advising you on debt. I think the company should be in the best position to design debt for them. Okay? You're saying, what if I come up with a kind of bond that nobody will buy? That might require a bank, that deal making part, right? But your objective is to try to get debt that looks like your company so that in good times you have lots of cash flows to service the debt. In bad times, as your cash flows drop off, your debt cash flows also decrease so you're not in trouble. So the next part of the process is about the practical ways in which you can convert this framework to designing the right debt. So I'm going to go through three different ways in which you can design the debt. The first one to me is actually the one that I stick with because it's the most general, the one that I'd like you to apply for your companies. The other two are more quantitative. So if those of you who are numbers oriented, want something more specific, might like the other two, but they're much more difficult to actually work with in practice. The first one is to break down a company into its businesses and look at what kind of debt is right for each business. The case of Coca-Cola and Boeing, they were in single business. It was easy. But in the case of Disney, remember in the theme park business, the movie business, the broadcasting business, now in the streaming business, very different business in terms of cash flows and currencies. You might want to design the right debt. I call this intuitive. You tell me what your company does, what a typical project looks like, and I'll tell you what the right kind of debt for that company is. The second approach is project financing. And this is especially useful for companies that actually borrow against projects rather than borrow as a company and fund projects. Big infrastructure companies often will take each project, borrow against the project. There, we're going to go back and use the same cash flows we used to come up with a net present value to actually derive what the right kind of debt for a company is. And the third approach is to look at how macro variables affect your company. When interest rates go up, what happens to your cash flows? When inflation goes up. So essentially, it's a very data-driven approach for saying, let's see what drives your cash flows and let's design debt based on what we find. So let's start with the intuitive way of designing debt. I'm going to start with Disney. I broke it down into five businesses, exact same five businesses I did the bottom-up beta. So with each business, I'm going to stop and ask, what's a typical project look like for Disney? And what's the right kind of debt given that project? The advantage for Disney is because it's a multi-business company, it has more flex in the process, right? One business can make up for another. But let's say take each one. So let's start with the movie business. Typical project is usually short term. I know some movies take forever to make. Its typical project is short term. And for Disney, at least in terms of the cash outflows tend to be in US dollars. They pay their actors in dollars. Often they shoot the movie in dollars. Unless they make some of the animation in India, and then you might have some of the. And depending on the Disney movie, the inflows can be either global or more US based. When they make action movies, the Avengers movies, the revenues are very global. Asia is a big contributor. When they make their animated or the Pixar movies, they tend to be more US centric. Okay? China, for instance, not interested in Pixar movies at all. They get very little revenues. So you tell me where your movies make their revenues. I can start to. So it should be probably short term debt, probably dollar debt because your outflows are in dollars. But movie success is measured by gate receipts, right? Wouldn't it be neat if we could tie the coupon rate on the bond to how well the movie does? Less of an issue for Disney, which makes dozens of movies, but you take a movie company like Lionsgate, which makes one or two movies, you might want to design your debt in such a way that if the movie does really well, gate receipts exceed a half a billion, you're willing to pay 15%, and the gate receipts drop through the floor, you'd like the coupon rate to drop. You say, who'd buy a bond like that? Disney actually issued Little Mermaid bonds where you and people actually bought it, right? Partly because they wanted to get the certificate and hang it up in their basement room and say, I lent money to make the Little Mermaid and tell their grandchildren, look, I was the one who funded the movie. No. But one of the most fascinating bonds ever issued were Bowie bonds. Have you heard of Bowie bonds? Huh? Do you remember how the bonds were constructed? And why did he have to do that, right? Usually they get paid by studios, so something must have triggered this, right? He actually ended up in a conflict with his music companies. He bought back the rights to all of his music, which left him with a cash flow problem. Rockstar cash flow problem don't go together, right? Seven Rolls Royces, how do you maintain them? So he approached a banker in New York, and again, I don't know his name. You could probably find it, doing a Google search. And the banker designed these bonds that were going to be, backed up by the music. But what made the bonds unique was the coupon rate on the bond was tied to how many. These were the days when you actually sold records. If the records went platinum, the coupon rate would be 12%. So, or if one day we woke up and said, David Bowie, strange looking hair, I'm never buying music from this guy again, the coupon rate would actually drop to 0%. If people will buy Bowie bonds, why not Little Mermaid bonds? Right? The bond market would be a lot more fun if you're running against Kim Kardashian bonds and LeBron James bonds and Steven Smith. So basically, all these. So you're backing it up with cash flows. There's a swimming pool company in the Northeast that actually issued bonds where they tied the coupon rate to the temperature, the average summer temperature in the Northeast. You can see why, right? Summer temperatures high, you see, you sell, your revenues are high. But it's a particularly cool summer, they didn't sell very much. There was an Italian soccer team that tied its bond coupon rate. They were actually in Division Two, whether they made it back to Division One or stayed in Division Two. People will buy all kinds of stuff. Why? Because they think they're experts on things they're not experts about. But here's my favorite example. Say you're an insurance company. Okay? Most of the years you collect premiums, you pay out, you pay out and most of the time you make money unless you have what? A catastrophe, a hurricane, that LA fire. Wouldn't it be neat if you're an insurance company and you borrowed money that in the event of a catastrophe, you'd still be okay? Design a bond from scratch. Leon, help me out. If I wanted to design a bond as an insurance company to protect me in the event of a catastrophe, I'm your lawyer, so tell me what you want me to put in as clauses to protect you. First step, you'd have to define the catastrophe, right? So can't just be if there's an earthquake that exceeds 8 on the Richter scale. Let's pick a high enough number. And what would you want to be able to do as an insurance company? If that big catastrophe happens, you want to cut back on interest payments, maybe suspend interest payments for 3 years, reduce your principal payment by 50%. You think, why would people buy this bond? Because the interest rate will be really high. It's again, you're not pulling a fast one. These are called catastrophe bonds. They actually exist. Small insurance companies use them. And the coupon and the principal on the bond is tied to a specific catastrophe. So if you're East Coast based, it might be a hurricane. West Coast based, it might be an earthquake or a fire. And increasingly, I think you're going to see that with insurance companies because it turned out that at one point in time, big insurance companies like Allstate or State Farm said, we don't need to do that because but if you look at the LA fires, the insurance companies that are exposed there, even the large ones, are looking at potential payouts that are so large that could tip them over. So catbots basically are trying to bring that in. So that's a movie business. Let's move on to the broadcasting business. Typically, again, short term, but you could go multiple seasons, and your success is measured with ratings, right? You don't want to issue rating sensitive bonds, but the ratings are not the ratings that you get from Moody's and S&P. It's the ratings that Nielsen measures. At least with traditional TV, that used to be the objective. With streaming, all bets are off. I wouldn't even know how to design debt for a streaming project because it's very difficult to trace out the effects on the cash flows because it might be more subscribers, higher, lower churn rates. Maybe you can tie the coupon rate to the churn rate, right? See if you can. No, but you're going to see some really creative ways in which these streaming companies borrow money because you want to tie again how well how well you do to how much you pay out. The theme park business should be the most real estate focused of Disney's many businesses, right? Long term, big infrastructure investments. And the cash flows will depend on where you're building the theme park. If you're building them in, you know, And even there, even though you might build them in the US, in Anaheim or in Orlando, you're drawing customers from all over. So if you could design your debt in a way that reflects that, you made yourself less risky. Okay? By now, you see the theme. You look at what your cash flows are driven by, you're trying to design the debt. The consumer products and the interactive, you can talk about, at least at that time, interactive was their growth business. If you had a business which should be issuing convertible debt, this would be the business to do it. Today, of course, interactive is gone. Streaming has taken its place. Start thinking about, if Netflix were to issue debt, what form should it take? It should probably be tied to the number of subscribers, right? And if it's content commitments, that's exactly what you do. That's why leases are such a great way for retailers to borrow, because it ties it to specific stores. The store doesn't do well, you abandon the lease and the debt goes away with the store. There's a reason particular kinds of borrowing evolve in businesses. It gives you a way to match up your debt to your assets. So I would like you to think of your company and start thinking about what a typical project looks like. There are multiple businesses in each business. And this to me is the creative part of debt design, because you're saying, what if I design a bond that has never been seen before? Odds are you won't be able to issue that bond because it's. But let's say you did this for a living and you ran into this for 5 companies. You say, I wish I had that kind of bond. After the 5th company, this might be a chance to create a type of bond. Do you think Lou Ranieri actually sat down and said, I'd like to think about real estate based? He basically ran into this constraint of, I have mortgage, I have all these mortgages as assets. How come there isn't a debt that is tied directly to the mortgages? He created mortgage backed financing because he ran into enough cases where he said that would help. And I think we're at a point where you could be thinking about macro risks and ways of bringing them into debt. And I'll let you think about the macro risks that are floating around. Maybe debt that is, some kind of a tariff component to it. Because if that is what's going to tip you over the edge, putting in, and again, you're not doing it to rip off the bondholders. They're getting a fair bond, but they think they're better at forecasting things than the rest of the market is, and this is what they want to make their bet on. So at least focus on duration, currency, fixed or floating. So each of the duration is going to be based on, whether your projects are long-term or short-term. Currency is going to be based on what currency your cash flows are in. Fixed or floating rate is going to be based on how much pricing power you have. And how would I know that? Take a look at your company, right? If it's a brand name company, it probably has got a lot of pricing power, it can pass it through. But if in a business that's intensely competitive, where it's difficult to push through price changes on your own, then you should be issuing floating rate debt. And finally, straight or convertible will depend on whether you're a mature company with relatively low growth in the future, the Costco, the Walmarts of the world, the Home Depots, or whether you're a growth company, a company like Palantir, where all of your value is going to come from future growth. Now, in fact, Palantir would be a fascinating company to design debt in, because you could tie it to the size of the defense contract and essentially look at, hey, if that is what's driving my cash flows, I should be trying to bring it into the into the bond. That's the first way to design debt. And to me, that's going to be the central way in which you're going to design debt. There's a second way you can design debt, and this is particularly useful if you want to borrow money against a specific project. Of all of Disney's businesses, the theme park business is probably the one that's best suited to borrowing money on its own. So bankers are lending money against a big infrastructure real estate project. You want to borrow money, it's going to be project specific. So here's what I'm going to do. I'm going to go back to the cash flows I used to get the net present value of the project. So this is from way back in time, session 8, 9, 10. There I used it to get the net present value, but here I'm going to use it for something a little different. So there are my cash flows each year. There's a big upfront investment. There's my terminal value. The way we compute present values, we discount them back at the cost of capital. So there's my $3.3 billion net present value that we got. I'm going to take each present value and I'm going to multiply by the year I get it. In a minute, I'll explain what I'm doing when I do this. So in the last column, I take the present value, multiply by the year. So minus 922 times 1, minus 730 times 2. That's the present value times when you get it. You add up the last column, you get 62,355. See, what the heck are you doing? If I divide the 62,355 by 3.3 billion, I've effectively what's called the Macaulay duration. In a typical bond, this is how you compute the duration. You take the cash flow, you take the present value. I've computed the duration of this project to be roughly 19 years based on the cash flows. How's that going to help me? If I'm going to go out and borrow money on this project, I want the duration of the debt that I issue to be roughly 19 years. Duration, not the maturity, right? Duration would mean either issue zero coupon bond with a 19-year maturity, or if it's a regular coupon bond, maybe a 25 or a 30-year bond, because remember, when there's a coupon, the duration is going to be lower than the maturity. Yes. T is just whichever year you get the cash flow in. So basically, it'll be 2 times minus 7. So it should be just that times that will always give me the last column. So it's in fact how we compute the Macaulay duration of a traditional coupon bond. I've just stolen that idea and applied it to a typical project and computed the duration of the project. Right? And here, of course, the currencies, you can, it's a real project. So you can then say, I want a debt that's about 19 years in duration, is mostly in Latin American currencies because it's a project in Rio. Does Disney have pricing power? I think so. I mean, I see the prices that people have to pay to get into a theme park. You know, they're not exactly lagging inflation. So if they want to issue floating rate debt, I would encourage them. So the bulk of debt design is right there, right? 19-year duration in Latin American currencies, perhaps a real, and then finally to top it all off, you know, if you can make it floating rate debt, go for it. And if you cannot do that, then you can issue debt in dollars and then try to use swaps or derivatives to get rid of that mismatch. But your end game should be after I'm done with all of this, I don't want to be exposed to this extra risk because I've used dollar debt to fund, you know, a Latin American project. Yes.
Project company.
Yeah. A company is just a portfolio of projects, right? So it's really a choice between whether you're borrowing against a project or a portfolio of projects. Caleb's question was about a single project, and there again, I drew to a portfolio. So think of a company as a portfolio of projects, right? Mhm.
The cash flow for you have let's say it's a short-term time movement. That duration.
The bookstore, the project is probably going to be finite, right? You're not going to get the terminal value. So long-term projects obviously will have that much bigger amount in year 10. But if you have salvage value instead of terminal value, I mean, if you remember the Celsius project, when you put the salvage value in, the duration shrunk. So in the Celsius project, if I were planning to run it as a 15-year project, I would have funded it with much more short-term debt than if I ran it as a perpetual life, a longer life. So your choice about how to run a project is also going to determine what kind of debt to use for that project. So the perfect theme park debt should be Latin American currencies, roughly 19 years in duration. And if possible, I would like to tie the coupon payments to how many people come to the theme park. So the theme park is a complete bust, my coupon rate drops. Less of an issue for Disney than for Six Flags, right? Because Disney has all these other businesses protecting it. Six Flags, you know, in fact, Six Flags probably in hindsight wished it had issued all its debt as debt tied to the number of people because it's a company that's hopelessly over levered and can't figure out a way to back out of that corner. But the more single business you become, the more you worry about mismatching your debt because it could take you down. Which brings us to the third way in which you can design debt. And I'm at least going to get started on this process because it's very data driven, right? So the third way, what I'm going to look at is how my company has done over time as a function of macroeconomic variables out there. As interest rates change, as inflation changes, because the data is going to tell you whether your company is cyclical or not. The data is going to tell you how your company does when the dollar gets stronger. And there are two dimensions on which I can look at my company. I can look at operating cash flows. Why? I want to see how much my income goes up and down. But I can also look at the value of my firm, which captures the present value of. So I'm measuring two different aspects of my firm, my year to year earnings and the value of my company. So with Disney, here's what I did. I went back to 1985. I got the operating income every year. So that comes right out of the income statement. If you have Capital IQ, you can download the data. I also downloaded the enterprise value. Remember, the enterprise value is market value of equity plus debt minus cash, the market value of the operating assets. Risk of stating the obvious. You can see earnings go up for the most part, but they have good years and bad years, and percentage changes are going to capture that. Same thing with the enterprise value. So percentage change in operating income and percentage change in firm value every single year. So that's my starting point. Start with the company, look at how your company is done over time. And I brought in terms of macroeconomic variables, three macroeconomic variables, and I'll talk about why each one matters. Four macroeconomic variables. First is I looked at the T-bond rate and how much it changed on a year-to-year basis. I wanted to see how sensitive my company was to changes in long-term interest rates. Second column, I looked at the percentage change in real GDP. I'll actually send you a link to this Federal Reserve site called Fred. Have any of you used Fred? It's an amazing site. It's the most amazing macroeconomic data site I've ever used anywhere in the world. And it's free. That's the best part of it. Right? So you can download pretty much everything from exchange rates going back 50 years to GDP, interest rates, T-bill rates, whatever you want to do going back in time. So that's my source for all of these. So that's a percentage change in the 10-year T-bond rate. So I want to be specific, or the T-note rate, if you prefer to call it by its right name. The second is a percentage change in real GDP every year. What does that capture? It captures how the real economy is doing. When that number is negative, you have a recession. That number is positive, you're growing. And the larger the number, the more you're growing. The third column, I looked at percentage change in the CPI. That captures the inflation rate change. Notice I'm looking at changes in each of these variables rather than levels, because I want to see the changes in my company as those numbers change. And the last column, I have the percentage change in the US dollar. You're saying against what currency? There's actually a weighted US dollar on Fred, which captures how the dollar moves against the other currencies put together. So the dollar gets stronger as a whole, that number goes up. So rather than track individual currencies, I've kind of created. So these four variables are the variables I picked. But if you're doing an oil company, there would be a fifth column there, right? What did you look at? You look at the oil price every year. So be creative, because the data is there. You're trying to ask, how does my company do as these external factors move? So here's the first thing I'm going to do. I'm going to look at how sensitive my company is to changes in long-term rates. I'm going to look at both operating income and firm value. I'm going to argue that when I look at that relationship, I'm going to get a sense of the duration of my company's assets. It sounds weird that looking at interest rates is going to do it, but I'm going to make that link. So I'm going to start by looking at how my operating income changes as interest rates change, and then I'm going to look at how much firm value changes as interest rates change. So here's my first regression. I took the change in Disney's firm value on a year-by-year basis and ran a regression against changes in interest rates on a year-by-year basis. I don't want to get too excited. The R squared is terrible. The T statistic is close to zero. So again, this is not something I want to take to an analysis and say this is, but to the extent that you run this regression, I'm going to argue that this coefficient that you see on the change in interest rates, minus 2.32, is actually a measure of the duration of Disney's assets. It sounds like a leap of faith, right? You're saying, why would running a regression of changes in firm value against changes in interest rates give you a measure of duration? I want to take you back to foundations. You talked about duration in foundations, right? What is the duration of a bond? There are multiple definitions. Give me, one or two. What are some of the what's the duration? What is the duration of a bond measure? Yes. One is it's a weighted average of when you get the cash flows, right? So if you have if you have a zero coupon bond, the duration and the maturity match up, it's 8 years. So one way we think about duration is in years, number of years, right? What's the other way to think about duration? Why do we care about, Kelly? What does it mean? It's a measure of how much your bond price will change for a so it's actually like a calculus. It's the first derivative, the bond price to changes in interest rates. For every 1% increase in interest rates, how much does my bond price drop? So it's going to be a negative coefficient, right? So interest rates go up, bond. So duration also measures how sensitive your bond price is going to be to changes in interest rates. Do you see the starting of a link? What is the regression coefficient measuring? It measures how sensitive my firm value is to changes in interest rates. That's exactly what duration on a bond measures. You're saying, why didn't we do duration the traditional way? Because I don't have cash flows in the company for the next 10 years in a face value. This is a kind of a shortcut. So if you think about duration, the duration of a bond is basically a measure of how sensitive a bond price is to changes in interest rates. And I'm going to argue that my regression coefficient serves exactly the same purpose. It tells me how sensitive. So if I have a company with really long-term assets, it should be much more sensitive to changes in interest rates in terms of dropping in value than a company with short-term assets. Boeing should be much more exposed to changes in long-term rates than a Dell should be because it's much more short-term. Right? So that's basically why. So if you think about duration as a percentage change in value, the traditional duration measures, which is what we use for bonds, we use the coupons and the face value and we back into duration. We can't do that with a company. So that's why instead we're running a regression, taking the coefficient of the regression and using it as a measure of duration. But I need to be open about the limitations of the approach. First is it needs fast data. If you try to do this for a Palantir or a DoorDash, problem you're going to run is you're not going to get 50 years of data like I did for Disney. You might get 5, 6 years of data, and it's going to be very noisy data. Second, when you run a regression and you get a coefficient, remember from the beta regressions, it comes with a t statistic and a standard error. So it's going to be noisy. And we'll talk about what to do about it. But it's just a different way of thinking about duration for a company than duration for debt by running this regression. I also ran regression of operating income against interest rates. Here, I just wanted to see, does my operating income go up or down as interest rates go up? And every 1% increase in long-term rates reduces my operating income by 7.2%. But T-bond rates in 2021 were 1.5%. T-bond rates today are 4.5% and rising. They briefly got close to 5% towards the end of last week. If you can take this regression through, that's not good news for Disney's operating income. Historically, its operating income has been hurt every time long-term for lots of different reasons. Might be some intermediate step that's not even been captured, but it's not good. Are there companies which might actually benefit from having higher long-term rates? What kinds of business you think will generate higher operating income with higher long-term rates? Usually it's financial service companies are the ones that you point to because they can reorient their assets as long as they're not locked in, right? So the argument is financial service companies can benefit because they can pass the interest rate through. But even there, you got to be careful that you don't have too many things. Remember, if you go back a couple of years, a lot of banks were exposed because of all these securities that they bought with low coupon rates, and then the interest rate went up. So duration here captures, how's that? My second stop is I'm going to look at how sensitive my company is to changes in real GDP. Remember we talked about cyclical, non-cyclical, and usually we have this thing of, auto companies are cyclical, but discount retailers are not. We don't know whether that's true, right? It's a completely empirical question. And here's the easiest way to see if your company is cyclical. If you run a regression of your company's income and value against real GDP, if your company is cyclical, you should see a big negative coefficient. Do you see why? When the economy is doing well, I'm sorry, big positive coefficient. The economy is doing well, you should expect to make more money, be worth more if the economy is doing. If you're not cyclical, the coefficient should be close to zero. And if you're counter-cyclical, and there are a few businesses that are claimed to be counter-cyclical, you should get a negative coefficient. Again, before I run the regression, I want to get that lined up. So when I look at the regression, here's what I see for Disney. A plus 6.7 for change in firm value and a plus 6.64 for change in operating income. What does it tell me? At least based on this historical data, it looks like Disney is a cyclical company, but and the coefficients are statistically significant. So it does look like having a stronger economy does help Disney as a company. You're saying that's obvious? Might as well get the data lined up. It does look. If you took Con Ed and ran this regression, you get a coefficient close to zero. Con Ed seems to be unaffected because it's a regulated utility by whether the economy is booming or it's going into recession. So we're running the regression against real GDP to get a sense of, is my company cyclical? Third, I wanted to see how Disney does when the dollar gets stronger or weaker. Okay? I want you to think about, as Disney, what businesses a stronger dollar would help them on, and what businesses it would hurt them on. Let's see what the collective. So, if you look at the theme park business, is it helped or hurt by a stronger dollar? The U.S. theme parks are definitely going to be hurt, right? Because people fly in and they have to pay higher prices. So stronger dollar to US theme parks. It's tougher to make the call on the Shanghai or the Tokyo, but in general, a stronger dollar is not good for Disney and the theme park business. In fact, I would argue they go down the path. The net effect of a stronger dollar is probably going to be negative. At least that's what my priors would lead me to believe. But we have the data. Let's see what the data shows us. It actually turns out that the firm value is almost unaffected by look at the T statistics 0.67. Remember the cutoff for that is 2. So basically, it doesn't look like a stronger dollar. Collectively, as a company, it looks like Disney is unaffected by whether the dollar gets stronger or weaker. And if you look at operating income, a stronger dollar does push down their operating income. And there's a puzzle here, right? You're saying if my earnings drop when I have a stronger dollar, how come my firm value doesn't? Because the firm value is other things that go into it, the growth rate, the cost of capital. So all those effects might end up evening out. So the bottom line here is Disney's
Sorry, I
operating.
really had a final interview. I have
If you're on Zoom, can you mute yourself, please? Yeah, I think that's somebody on Zoom. So the operating income here is clearly affected by the dollar, but the firm value is not. Last piece, and then we'll wrap this up. So I look to see whether Disney's firm value, and what am I doing when I look at inflation? What am I trying to measure? Pricing power, right? If you have pricing power, your earnings should go up as inflation goes up. And if you're able to pass it through, your firm value shouldn't be hurt by inflation because your earnings go up, your discount rate goes up. And with Disney, that's exactly what we find. The change in inflation rate pushes up my operating income, so they pass it through to their customers, but it has almost no effect on value. So again, the objective here is you're trying to get a sense of what does my company do as these macroeconomic variables shift. Right? The bottom line is we bring them all together. Here's what the regressions lead me to believe about Disney. That collectively, if I believe the regression, and I'm going to put a qualifier there because the T statistic was so close to zero, the duration of the asset is 2.33 years. It is increasingly cyclical. Okay? It is hurt by a stronger dollar, and it tends to move with inflation. All that would lead me to design debt for Disney that matches up to what I found from the regressions. So I'm going to stop there. I will send you the link to this macro because I've updated on an annual basis. All you have to do is enter your numbers and see what you get. I'll also tell you, because it's a small data sample, you're going to get strange looking results and terrible T statistics. Next class, we'll talk about what to do about those. So I'll see you on Wednesday.